Welcome back to the Intrinsic Mover. Today we are looking at a titan. We're talking about Alphabet, parent company of Google. And let me tell you, the headline number is staggering.
It's historic.
They just reported their Q3 2025 earnings, and for the first time ever, they cracked the $100 billion revenue ceiling in a single quarter.
$100 billion.
With a capital B.
$100 billion in 90 days. It's absolutely massive scale.
But.
Why but?
There is always a but with these guys lately. Despite smashing estimates, despite the cloud business absolutely ripping higher, the report is, well, it's messy.
Messy is putting it politely. It is a forensic accountant's dream and a regulator's nightmare.
That's what we have to solve today. You have this incredible AI offense driving growth, but it's clouded by massive fines.
Oh, that issue.
Yep, them antitrust threats and some earnings numbers that, quite frankly, look a little inflated.
Exactly. You have to strip away the noise to see the real engine. We've got a $3.5 billion fine dragging down the left side, and a $12.8 billion paper gain puffing up the right side.
Okay, so to make sense of this beast, we are going to run it through our 5-part framework. We're going to look at the scorecard, the profitability, the forensic check on that cash,
and the regulatory elephant in the room.
Let's get to work. Now at a glance scorecard.
All right, let's look at the headline numbers versus what Wall Street expected.
So, top line revenue.
The best.
They reported $102.3 billion. That is up 16% year over year.
Which is an acceleration. And critically, it's a clear beat. Consensus was looking for about $99.9 billion.
A clear beat.
So they beat by about 2.5%. When you're this big, beating by billions is hard to do.
And the bottom line? Diluted EPS came in at $2.87, up 35%.
Which crushed the estimate of $2.26. That's a 27% beat. But put a pin in that EPS number.
Okay, pin in.
We are going to come back to that later because it is not as clean as it looks.
Now, I want to talk about the star of the show, Google Cloud.
Oh, this is the story of the quarter. For years, people asked, can Google actually compete with AWS and Azure? Well, Q3 says yes.
Google Cloud revenue hit $15.2 billion, up 34%.
34% growth. That is accelerating from Q2, and it's significantly outpacing the overall business. This is entirely driven by the AI stack.
The AI infrastructure.
Exactly. Companies are lining up for Google's TPUs. Those are their custom chips. And the NVIDIA PUs they have hosted. They mentioned billion-dollar deals with customers like HCA Healthcare and LG.
So the narrative here is that the AI boom isn't just hype for them anymore. It's actual invoices.
It's tangible revenue. And even search, Google Search and other, grew 15% to $56.6 billion.
Which answers the big fear, right? Everyone thought ChatGPT or Perplexity was going to kill Google Search.
Right. But search is resilient. They rolled out AI overviews, those AI summaries at the top of the page, and management says it's actually increasing usage, especially with younger users. So, on the scorecard, it's a massive beat on execution.
The engine of profitability.
Now we have to put on our surgical masks and dissect these margins, because this is where things get complicated.
Okay, let's start with the operating income. It came in at $31.2 billion. That's up 9%.
Up 9%? Wait a minute. Revenue was up 16%. Why is operating income lagging revenue growth?
I think I know the answer.
Usually, big tech has leverage. Profit should grow faster than revenue.
It's the fine.
It's the fine. They recorded a $3.5 billion accrued fine from the European Commission regarding antitrust in ad tech.
$3.5 billion. Just poof. Gone.
Just a cost of doing business, apparently. That hit the GAAP operating margin hard, dropping it to 30.5%.
But if we play devil's advocate and strip that fine out...
If you exclude the fine, The non-GAAP margin was actually 33.9%. That is strong. It shows that underneath the legal trouble, the business is actually getting more efficient.
Even with the AI spending?
Well, that's the other pressure point. R&D expenses rose 22%.
That is a huge jump. What are they spending that on?
Two things. One, talent. They are paying a fortune to keep AI researchers from leaving for OpenAI or Anthropic. And two, depreciation.
Depreciation?
Yeah. When you buy $24 billion worth of servers, which we'll talk about in a minute, you have to depreciate them. That hits the R&D line. So, the cost of the AI arms race is real, and it is hitting the P&L.
So the engine is powerful, but it's running hot, and the regulators are throwing sand in the gears.
Perfect analogy. This slide is the architectural blueprint of the company. It tells us exactly who is paying the bills and who is driving the future.
And visually, it's dominated by that massive purple tower on the left. Google services.
The cash cow. Revenue hit $87.1 billion. That is search, YouTube, Android. It's the foundation.
And look at the profitability on that. $33.5 billion in operating income.
That is a 39% margin. Think about that. For every dollar of ad revenue they bring in, they keep nearly 40 cents as pure operating profit. That is the bank account that funds the entire AI war.
But the real story, the momentum story, is in the middle, the blue section, Google Cloud.
This is where the narrative flips. We see $15.2 billion in revenue, which is accelerating. But Boyd, look at the margin line. That is the magic number.
It says 24% margin. They made $3.6 billion in profit.
Exactly. A year ago, that margin was sitting at 17%. Jumping to 24% in 1 year? That is what Wall Street calls pure operating leverage.
So they aren't just selling more cloud.
Right.
They're getting way more efficient at running it.
Precisely. The cloud business has graduated. It's no longer a startup burning cash. It's a profit engine.
Which brings us to the far right, the little red bar. Other bets.
The moonshots. Waymo, Verily, the science projects.
Revenue is tiny, just $340 million. And the operating loss? Negative $1.43 billion.
They are burning about $1.5 billion a quarter. But here's the context. When your cash cow on the left is printing $33 billion in profit, you can afford to lose $1.4 billion betting on self-driving cars.
So the summary here?
It's a balanced machine. Services pays the bills today. Cloud drives the profit growth for tomorrow, and other bets is the lottery ticket for next decade.
Let's flip to financial strength and shareholder rewards.
Okay, remember I told you to put a pin in that EPS number?
The $2.87 earnings per share.
Right. Time to take the pin out. We need to do a forensic check here.
I'm looking at the other income line on the statement. It says $12.8 billion.
$12.8 billion. This is listed as other income.
Where did they get $13 billion? Did they sell a division?
No, that's the crazy part. This is primarily unrealized gains on equity securities.
Translate that for us.
It means they own stakes in startups, likely companies like SpaceX, Stripe, maybe Databricks. And because the estimated value of those startups went up this quarter, accounting rules say Alphabet has to book that paper gain as profit.
So it's not cash, it's not ad revenue. It's just an accountant changing a number on a spreadsheet because a startup they invested in got a higher valuation?
Exactly. And that added significantly to the earnings per share. So when you see that 35% EPS growth, you have to know a huge chunk of that is low-quality, non-operating paper gains.
That is a massive caveat. Okay, but let's look at the actual cash, the real money.
The real money is still flowing. Operating cash flow was $48.4 billion. They are printing money.
And they are spending it just as fast. CapEx, capital expenditures, hit $24 billion in just this quarter.
That is an annualized pace of nearly $100 billion a year on servers and data centers. It's the AI toll. You have to pay to play.
And despite that massive spend, they still bought back stock
$11.6 billion in share buybacks.
and paid $2.5 billion in dividends.
It's a fortress balance sheet. $98.5 billion in cash reserves. They can afford the fines, they can afford the servers, and they can afford to pay you. But investors need to be wide awake about that other income distortion.
The road ahead.
This is the strategy slide. Where is this ship steering?
Well, first off, they are doubling down on security. They have a pending acquisition of Wiz.
Right, the $32 billion deal for Wiz. This is a strategic move to bolster Google Cloud security. They want to beat AWS in the enterprise. It's expensive, but it widens the moat.
And what about the guidance? What are they telling us about next year?
They raise the CapEx guidance again. They now expect to spend $91 to $93 billion in 2025.
That is aggressive.
It signals they are seeing insatiable demand for AI. They wouldn't build the data centers if customers weren't asking for them.
But we have to talk about the dark cloud, the antitrust overhang.
This is the high-risk part of the profile. We have the DOJ remedies decision coming late 2025 regarding search.
And the court already ruled they are a monopolist, right?
Correct. The court said guilty. Now the DOJ is asking for remedies. We're talking about potential structural breakups, forcing them to sell Chrome or Android, or banning those default deals with Apple.
If they lose the Apple deal, or they pay to be the default search engine on iPhone, that changes the game.
It's an existential risk. It's the single biggest thing holding the stock multiple down. The numbers are great, but the judge is scary.
Now, the final narrative.
Let's synthesize all this complexity into 3 themes for Q3 2025.
Theme 1.
The pivot to offense is working. Cloud growth accelerating to 34% proves that Google isn't behind in AI anymore. They are monetizing it. The infrastructure bet is paying off.
Theme 2.
Earnings quality is mixed. You have to be a sophisticated investor here. Yes, the headline beat was huge, but it was padded by that $12.8 billion paper gain. Don't be fooled by the raw EPS number. Look at the operating margin. That's the truth.
And theme 3.
The regulatory tax. Between the $3.5 billion fine this quarter and the DOJ looming next year, Alphabet is fighting a war on 2 fronts. One against Microsoft for AI dominance, and one against the government for its existence.
So, final verdict?
It's a buy on the business, but watch on the judge. The valuation is reasonable, the buybacks are strong, and the cloud growth is real. But you have to size your position knowing that 2025 carries binary legal risk.
Incredible analysis. It's never boring with Alphabet.
Never.
Thanks for breaking it down. And remember, folks, this is for informational purposes only. Do your own diligence. We'll see you next time.